It was a big week in the semiconductor industry as we had earnings from Qualcomm, ARM Holdings, NXP. We also had earnings from Super Micro Computer. It was obviously a presidential election week here in the United States, and you had former President Trump returning to office early next year. But we also got information out of the current administration continue to ratchet up export controls on all of these semiconductors, certainly the high-end ones, into the country of China. We'll discuss if the former president that is now going to become the current president, will he continue the Joe Biden administration policy to very much restrict high-end GPUs and computer chips moving into China? Or will Donald Trump use that as a negotiation ploy to potentially open up new trade deals with China and potentially unlock a lot of revenue that these companies have been sitting on? We'll also talk about these stocks from a technical perspective. As you can imagine, many of them got a bump this week as the stock market just went to new highs on the backs of the presidential election. Welcome to the Semiconductor Show here on Equity Empire. There's always timestamps down below if you want to jump around to the stock that has your interest. This is a weekly show. We record it every weekend. Now, let's kick things off like we always do with the big boy. We got to talk about Nvidia. Started the week at about $136 per share, and like a lot of stocks, especially the big ones, they were up big this week on the backs of potentially lower regulation, lower corporate tax rates. Nvidia skyrocketing up over 8% to finish the week at about $147 per share. In fact, I think we hit a fresh 52-week high on Nvidia, cementing a well north of $3.6 trillion valuation. Now, the company giving us some clues on forward demand. We'll talk about Taiwan Semiconductor later in the show, but they reported October revenue, which was giving us further indication that Nvidia's revenue for the upcoming quarters should be spectacular. Now, Nvidia is asking SK Hynix, their memory provider, one of their main memory providers, to advance supply of the next generation of high bandwidth memory, this would be high bandwidth memory 4, by about 6 months. As most of you probably know, Nvidia has reduced their cadence or their release date time for their high-end GPUs. It used to be on a 2-year cadence. They've reduced that to releasing a new chip every year. And so they need SK Hynix to come to the table with this next generation high bandwidth memory even faster than before so they can test and prototype these chips. Because as you remember, maybe a month or two ago, Nvidia had a delay in Blackwell, which sent the shares lower, but created a buying opportunity. Now, we have more indications of demand from Supermicro, obviously a key supplier and customer of Nvidia as they buy these high-end GPUs, configure them for clients around the world. We heard from Supermicro Computer. Obviously, the stock has been embattled in lots of accounting fraud and not being able to release its financials. Also, as you know, last week's show, we talked about Ernst & Young basically quitting from the company as it relates to their auditor process. Now, year to date, shares of Supermicro down about 13%. Even over the past year, shares are now down about 6%. It has investors wondering, is it a buying opportunity? Is now you have just a $14 billion valuation and just a 8 times forward on this one. So once a high-flying stock with a massive PE, massive price to multiple, massive market cap could now be viewed potentially as a value stock, believe it or not. Now, we got some clues when the company announced their Q1 results. Now, keep in mind, they don't have an auditor. These are unaudited. The company hasn't filed its annual report, and this is several months after due. They are also under notice by the NASDAQ to file or come up with a plan to file that annual report. Otherwise, they risk getting delisted from the NASDAQ. And if they get delisted, well, your shares of Supermicro, while they're currently at 24, would probably be worth significantly less than that. So this company has a little bit of work to do. But on these earnings and certainly on the conference call, if you take the management comments at face value, which I'll show you here in a minute, if you take these comments at face value, well, there could potentially be an opportunity with Supermicro if you're comfortable with management's inability to release financial documents on time. Personally, I would wait until they release these documents on time. I would wait until you get a new auditor signing off on these things. I'd also probably wait until maybe you get a separation between the CEO and the board of director chairman. If you get a separation there, well, it could potentially create a buying opportunity. But when the company announced their Q1 results, it sent shares even lower as it came well below expectations. Revenue came in between $5.9 and $6 billion. We'll call it right about $6 billion. Remember, these are not audited. They didn't even show the audited results or the unaudited results. This is just the company telling you where this revenue is going to come in. Previously, they said that Q1 revenue was going to be between $6 and $7 billion. And again, the company is reporting that it's actually going to be a number closer to $6 billion. They also gave a second quarter guidance as well, which came well below expectations. The company is expecting $5.5 billion in revenue to potentially $6.1 billion in revenue. I don't have the former numbers, but they are significantly lower than what Wall Street was expecting. In fact, you see here graphically that the expectations on the revenue side have came in. At one time, those Q2 revenues were expected actually to be closer to about $7 billion. And I do want to repeat, the company is expecting those numbers actually closer to about $6 billion. From the earnings side, you also see a dramatic revision by Wall Street for the upcoming quarters as revenue is expected to come in a little bit over at Supermicro. Certainly earnings will fall at a similar pace as well. Now, for a company with an 8 times forward PE, you sure got still rapid revenue growth as Wall Street is still expecting 61% growth for the first two calendar quarters of next year. And it should flatten out as you get into the back half of next year as the company starts lapping rather high revenue numbers. Now, the CEO got on the conference call and did explain one of the reasons why the revenue for the first quarter and the second quarter is coming up light of expectations. And he said this, I guess the major reason because there are some customers waiting for the new chip, the Blackwell chip, as you know. So people are waiting for the new solution. So I guess that's the major reason. And our capacity continues to grow and our liquid cooling solution is fully ready. Again, we can produce 1,500 liquid cooler racks per month now. So we are fully ready. That's waiting for the new chip to be available. And then I believe we can grow our market share and revenue after that. So this is what the CEO said in response to questions on the conference call, asking the company, hey, why is your second quarter revenue well below expectations? And why was your second quarter guidance also below expectations that were set by Wall Street as well? The company basically responded, I don't want to say blaming Nvidia, but basically the delays and potentially the power of the Blackwell chip, that customers just want to wait for the Blackwell chip to come out because it is so much better and so much more powerful and offers much higher ROI and total cost of ownership than the previous H100 and H200 chips. Company also said on the conference call that Nvidia hasn't really wavered from an allocation standpoint, although we did get news releases that contradicted that a little bit, that Nvidia was shifting around supply away from Supermicro Computer to other competitors, although that remains to be seen if that all applied to the Blackwell chip. The company did emphasize that they are in constant communication with Nvidia. They constantly want to get full allocation of the Blackwell chip. They reassured investors that they would get the full allocation and that revenue would continue to expand, and not only expand, but they have the capacity as they opened up a new facility in Malaysia, a new manufacturing facility in Malaysia, to insert those Blackwell chips into servers and deliver those to customers. Now, whether or not that you believe this management, which again has not been able to deliver a set of audited financials in several months now. Also, many of the reports which we've gone over on the show on the Hindenburg, not only audited related, but it also goes against governments or governance and other types of fraud that the company could potentially be found liable in the future. So this is one of these stocks where if you are a more of a gambler and more of a speculator, this is one of those stocks which certainly would fit the bill. If you're more like me and you like to trade and invest money in more of the sure thing, I would actually take the comments by the Supermicro CEO and I would actually attribute them back to an investment actually in Nvidia. That is because the company is basically endorsing the fact that the Blackwell chip demand is going to be so super hot that is impacting current demand, and that once Blackwell is in full production, probably towards the first half, maybe even just after the first half of next year as we get into calendar Q2, Q3 of next year, that the demand should be off the charts for Blackwell. Instead of risking my hard-earned money in an investment in Supermicro, I'd probably rather just buy some more Nvidia. You can let me know down in the comments below what your fancy is. Now, moving over to another semiconductor stock that we don't really cover a lot of regular news on, but is coming up in the news more and more often. That is Qualcomm. That is in part due to the fact that they have a Snapdragon chip, which is a very, very well received, highly rated, not only in cell phones, but it's now making its way into laptop computers as well. You have Intel kind of falling on its sword, so to speak. And so Qualcomm is picking up some of that business. Now, over the past 5 days, Qualcomm shares went from about 164 up nearly 4% the finished week at about $170 per share. Qualcomm year to date is now up about 18%, and over the past year, it's seen its shares rise by about 42%. The company announced their Q4 earnings this week. Revenue came in at $10.24 billion. That was 18% growth year over year, and it beat expectations by about $310 million. Now, in terms of valuation over at Qualcomm, it's always been relatively attractive. Even after these earnings, you have a forward multiple of just 15 on this one and about $190 billion valuation, and you got about a 2% yield. So as those yields on those treasury notes continue to pull back, that 4 or 5% that you used to be getting in a savings account or money market account, as those interest rates continue to walk back, if the bond market cooperates, well, a 2% yield on a stock that is growing at 18% year over year and trades at a reasonable 15 times forward valuation, well, stocks like these start to look more and more attractive. Now, from a financial perspective, it's exactly what you'd expect from this company, just consistently growing their total revenues from $8.6 billion last year up to about $10.2 billion. They've controlled their total cost of expenses, which went from $7.2 billion up to about $7.7 billion. Notice your operating income ballooned nicely by over $1 billion, from 1.4 up to about $2.6 billion. You flow all the way down to net income. You printed nearly $3 billion in the quarter. For the past 12 months, you printed about $10 billion last year. It was 7.2. Now, from a balance sheet perspective, company has plenty of cash and cash equivalents on their balance sheet. In fact, total assets sitting at about $25 billion. Inventories flat year over year. That's nice to see. They're controlling that. Long-term debt sitting at about $13 billion. Some of it's rolled over to the short-term debt. But when we roll down here to cash flows, you'll see there's nothing really to be overly concerned about. For the 12-month period, the company printed about $12.2 billion of operating cash flow. Now, they did invest some of it in this business, but they're not trying to fabricate chips like Intel is, so they don't need a ton of money. In fact, they invested just $1 billion just over the past year, only $1 billion over the past year on capital expenditures. Everything else is going to be going back to the repurchasing of the common stock and those dividends. So Qualcomm is just one of these wonderful stocks where you're not paying a huge multiple on it. You're getting a solid dividend, certainly as interest rates continue to walk back. You're getting good revenue growth. You're getting good product trends. And overall, company looks very solid. They continue to buy back stocks and pay that dividend and increase the dividend. Now, interestingly enough, they compete a little bit against Google as well, as they put these Tensor G6 chips inside of their Pixel phones. Interesting anecdotal note coming out of Android Authority, that's where this article comes from, is that the Tensor G6 chip is not meeting the expectations over at Google. They need the cost of these chips to actually get down to about $65 a chip. It compares against the Qualcomm chip, which costs about $150. So it's interesting the fact that Google needs to get their total cost chip down to about $65 to make the business viable. Otherwise, maybe buying the chips from Qualcomm at $150 might seem a better deal for the company from an economics perspective. Now, also, this article goes into the fact that Google is aware that these Tensor chips that they're putting into the Pixel phones are, quote, not good. Compared to Apple and Qualcomm, they're not good, both on battery life, but also more importantly, maybe on thermals. As you're recording videos and those types of things, the darn thing heats up so much that I think 28% of the negative reviews of the chip actually relates to thermals. They also said that users expect about 36 hours of battery life on a cell phone these days, maybe less based on usage. But the company noted that some users aren't even getting a full day of battery life. So this is, in my opinion, bullish for Apple, as they have a big chip division and they're probably a year or two ahead of Google. But this is also probably bullish for Qualcomm as well. Now, one thing that maybe potentially not be bullish for Qualcomm is the fact that Apple is working on its own in-house 5G modem. Now, I will say, for the past couple of years, I have read a lot of press releases that Apple is trying to come to market with its own modem chip, in-house developed and manufactured, although they'll use a partner manufacturer, instead of relying on Qualcomm's technology. And it was supposed to come to market already or be closer to the finish line, but it's something that continues to get pushed back. Qualcomm also, I think, continues to come to the table with Apple, probably offering them more and more favorable terms. So this will be an overhang on the stock, as it is worth about $1 billion in annual revenue for Qualcomm. And when you looked, when the company printed about $10 billion of operating income, that is rather significant. And this is obviously revenue and not necessarily profit, but could mean that Qualcomm has some competition when it comes to Apple. Although again, these press releases that Apple has been working on a modem chip has come forth numerous times. In fact, the last time it was happening, they had to go back to the table with Qualcomm and draw up a new deal. Now, moving into our next company that we'll talk about is ARM Holdings. Started the week at about $139 per share, little ups and downs, but I'm seeing you finish the week up 6% on ARM Holding to about $147 per share. The company announced their Q2 earnings. Revenue came in at $844 million. That was just about 5% growth. It did beat expectations. ARM Holdings is not Qualcomm. In fact, they don't pay a dividend, and their PE is a massive 94 times, and their revenue growth, at least in the most recent quarter, is not even close to Qualcomm. So this company's got a lot of makeup that they need to do, but it looks like in the upcoming quarters, Wall Street is expecting it. For Q3, you're expecting revenues at $944. That would be about $100 million over the quarter that they just reported. And as you move into calendar year next year, you should be over $1 billion, and that would be between 20 and 30% growth, maybe even as high as 40% growth year over year. Now, what the company is doing is it's switching more and more of its clients onto this ARM version 9, which is the new version of their license, and that comes with a higher royalty and likely higher profit. So as quarters continue to roll over, customers will roll off the ARM version 8 and ARM version 7 and older licenses, and at least on the newer kind of cutting edge devices, they'll be required to use the ARM version 9 license, which again comes with higher revenues. Now, what I've noticed with this company is it's done a very nice job, despite rather mediocre revenue growth, again, going from 644 up to 652. It's not really that great of a business. At least that's on the external customer side. Your total revenues went from 806 up to 844. Your gross profit, though, it's a wildly gross profitable business, from 760 all the way to 812. So if you control your operating expenses, your operating profit should increase. And notice what the company did. Again, on higher revenue, from 916 operating expenses last year down. Yeah, so they drove down their operating expenses over at ARM Holdings, down to about $750 million. So they're doing an excellent job. Again, when you have a high valuation and some lumpy revenue, where some quarters you're only growing 5% and some quarters you're going to grow 30 or 40%, you want to control these operating expenses. And that's what this company did. Your operating income basically came in flat, but that's a $64 million. But again, when you're talking about a company worth over $155 billion, $64 billion of operating profit in a quarter, it's not really going to cut it. But from the rest of the perspective of this company, they have plenty of cash. They have almost no liabilities. In fact, total liabilities coming in at just $2 billion. They basically have that in cash, let alone some of the account receivables that they have. From a cash flow perspective, companies basically break even, at least in the most recent quarter. If you stretch this out to a 6-month basis, they're actually losing a little bit of money, but different than most semiconductor companies, certainly companies like Intel, Taiwan Semiconductor, the ones on the manufacturing side. This company is not manufacturing anything. In fact, they have very little expenses. So if this company, that is why this company has a high valuation, because Wall Street is basically pricing in the revenue growth that you're supposed to see over the next several quarters, probably even the next several years. that will generate higher operating cash flows. And then those operating cash flows basically don't go into anything. No manufacturing facilities. Maybe you have to purchase some property, plant, and equipment, just $53 million in the quarter, but that seemed like an acceleration over the previous couple of months. So this company will be a cash flow printing machine if it can scale up its business into that stratosphere. Now, company on the kind of the opposite end of the section is Taiwan Semiconductor. They're obviously investing heavily into capital expenditures. And over the past 5 days, it saw its shares rise from 192 up about 4.4%. Finished the week now over $201 per share. But we have U.S. orders of Taiwan Semiconductor manufacturing to stop some chips shipments into China. As you know, we've already had massive sanctions put in place by the current Biden administration, stopping basically all of the high-end chips moving into the country of China. And now you have even more orders. In fact, we see this regularly. Seems like every 3, 4, 5, 6 months or so, the Biden administration, for the entire length of their administration, so nearly 4 years at this point, they have consistently layered on sanctions into the country of China. We also see the fact that they are being instructed to literally halt manufacturing advanced AI chips for China. That will be coming next week as, again, the Biden administration puts on a set of rules. The countries and the companies kind of find a way to work around them. As you know, Nvidia has kind of created special chips just for the country of China. Sometimes these things get backdoored into shell companies or other areas of the world and then get funneled into China. The Biden administration continues to try to close those loopholes and close those gaps. And so Taiwan Semiconductor, being a major partner of many U.S. companies, wants to remain in the good graces of the United States, and they continue to try their best, at the very least, to try to show that they're complying to these regulations. You also have the chip equipment makers, the ASMLs, the Lam Research, the KLAs, Applied Materials, those types of companies. They're also getting letters from basically bipartisan chair people here in the United States saying that you better not be selling stuff to China. Now, the great question a lot of people have is, will this carry over to the Trump administration? What I would say is probably one of the biggest difference between the Biden administration and the Trump administration is the Biden administration. Let's assume that if Biden were to run again and he got 4 more years, or if Harris were to have won and she basically got 4, maybe even potentially 8 years forward, they would have just left these on and they would have just continued them and it would have been status quo. That's what a traditional politician does. Donald Trump, as you mostly know, is not really a traditional politician, although he's more of a politician probably this time around than he was back in 2016. I think Trump is going to potentially try to use these sanctions as leverage to get the Chinese to do something else. Maybe it's going to be buying farm products or buying other exports that we have here in the United States. Maybe it's to buy oil. One of the plans that Trump has is to try to export more oil out of the country of the United States, generate revenue not only for the country, but for companies here as well. That could be a potential bargaining chip that, hey, if you buy X amount of our oil and our soybeans and some of our other crops, well, maybe we'll give you access to more and more of these computer chips. Who knows? Be interesting to see. I am constantly looking for opinions from the Trump administration on these types of things. Certainly, he's forming his staff and forming the people around him that'll make these decisions. And obviously here on the show, something that we'll talk about quite a bit is, again, we move into next year. I think it's January 20th when the former president will become the current president again. Now, bullish news out of Taiwan Semiconductor, and this applies to all semiconductor stocks, is I think for the 3rd month in a row, we've had near 30%, even in some cases over 30% revenue growth year over year for the company. The 29% growth is year over year. In fact, the company grew nearly 25% just month over month. So the company is growing at a rapid pace, not only year over year, but month over month. This is bullish for basically all semiconductor stocks, including Nvidia, I believe, as well. Now, here's an interesting anecdote in that he is saying, this is Taiwan Semiconductor's chief financial office, he's saying that the power bill in Taiwan is going to rise faster than everywhere else. And he says basically the price has doubled over the past few years. And so next year, we think that the electricity price in Taiwan will be the highest in all of the regions that we operate. So this could be very interesting, the fact that they're opening up that chip manufacturing plant. In fact, I think they've already got some production coming out of the one here in Arizona. And I believe by the first half of this coming year, you're at basically full production at that Arizona facility. It'd be interesting if the former president, Donald Trump, comes into the office and he's able to drive down energy prices. And I think he probably will, not necessarily in the short term, but the long term. If you get more supply of oil onto the market, that should do a lot to drive down energy cost. Be interesting to see if it becomes more and more profitable to actually manufacture these chips outside of Taiwan and into places like the United States. This also seems like, to me, it would create an investment opportunity, because it looks like Taiwan needs to invest in its energy grid to drive down the cost. And so that could create some short-term buying opportunities there. Now, a stock that we talked to, or at least reference on the technical segment, also reported their earnings, and it didn't go well, at least initially. Shares of NXP started the week at 236, traded down into the 220s, but was able to find, you'll see this technically as well, able to find some support and bounce back to being down about 1% on the week. Unfortunately for the company, revenue came in line with expectations, but it was a decline year over year by about 5.2%. Revenue coming in at about $3.25 billion. You also got the fact that the company is giving guidance between $3 and $3.2 billion for the upcoming quarter. Unfortunately, Wall Street had expectations closer to $3.36 billion. So the company coming up short across the board. It's really the product mix that NXP operates. They're more heavily in automobiles. And certainly when CES comes around in January, I'll be sure to give you an update on NXP, as they always have a great setup there. I'll be attending the Consumer Electronics Show. I think it's the first or second week of January in Las Vegas. If you happen to go to that, leave me a comment down below. Maybe we can have a meetup. Now, moving over to the technical segment of the show, we talked about on last week's show, the SOXX ETF was a buying opportunity. It was sitting at the bottom of the channel, and you kind of skipped your way back up to the middle of or approaching the middle of the channel. You continue to get bullish reads. Again, we'll get earnings from Nvidia in about 10 days. You'll hear from some of these other companies as well. Could continue to drive this one higher. As you start approaching the middle of the channel, that's when you should see some resistance. So that one's still looking bullish. Now, SMH is a little bit more concentrated in Nvidia, so it's still close to a higher high. Although if you continue to see bullish action in the stock market, this one will continue to walk back, probably back closer to the $300 level. You had a new higher high confirmed with Nvidia. If you came in with me and bought this one on the initial dip back here in September, you're up pretty nicely. This one, again, reports their earnings on the 20th. That'll be Wednesday, November 20th. That'll be a big day for Nvidia and the semiconductor market. And it could potentially, depending on how the company's revenue comes in, I think it's not only revenue with Nvidia, it's how they explain the Blackwell launch and the ramp up. They're able to show investors that the demand is there. And we've seen it with Supermicro. We've seen it with TSM. Some of TSM's revenue is actually the Blackwell chip. Well, if Nvidia is able to explain that well enough, well, you've got areas up here back to the middle of the channel and maybe even a new touch to the top of the channel. That's obviously taking you into a stratosphere that we've really seen no company ever achieve. Now, AMD made a very nice technical bounce. I'm going to change this green line to purple just so you can see it. But we've actually got a long-term trend dating back to 2015. So it's a near 10-year price chart that has held with AMD. And you see, most recently, we have found footing and we're able to bounce off of it. That's a good sign for AMD. Converging will be two areas of resistance up here at 160. In fact, if you bought AMD on this dip, you probably could take some profits here, bag a $20 per share profit. With AMD on the long term or the more bullish side, you do need to break through this area of 160, push into the 170s, ideally back into the 180s, 190s with this stock. And that would be very, very, very bullish. And you're continuing to buy the dips on that one. Now, Broadcom, a little bit different scenario than most of these stocks. They don't report their earnings till the 5th, although I expect some price action on this stock when Nvidia reports their earnings. There were reports, I think it was this week, that OpenAI is planning on using Broadcom for potentially a new custom silicon design that would be bullish for Broadcom in the future. And we are basically approaching new highs. Dips in Broadcom certainly can be bought. Now, Intel is absolutely looking spectacular from a technical perspective. We should reach some resistance about where the share price is. There is some consolidation there, even higher than that, up at about $29 per share. The company will have filled the gap from the gap down when it reported its earnings and its disastrous results several months ago. But it is looking good. Looks like you have found some footing here, potentially with a new administration that is super pro manufacturing here in the United States, although give credit to the Biden administration for passing the CHIPS Act, investing into these companies to allow them to give more incentive to open up these manufacturing facilities here in the United States. Intel is looking pretty good, actually, from a technical perspective. Qualcomm also looking pretty good technically. You would like to see maybe a larger dip in this one, get an opportunity to buy lower, but I showed you from a valuation perspective, this one's already trading pretty low, so it would take quite a bit to get this one to want to work even further back. That one is looking pretty darn good to me. TSM, as we noted, just confirmed a new higher high. This one just looks absolutely stellar. ASML continues to hover down here. This company would benefit if my theory around the Trump administration that they could potentially use the exports of chips as a bargaining chip with the country of China to buy either oil or soybeans or combination or both, or other types of exports coming out of the United States. The Trump administration could use that as a bargaining chip, again, opening the door to the China market for companies like ASML. If it does, this stock would skyrocket. In fact, you probably would make a new higher high in the shorter term if that market was unlocked. I think this one is a buy at these levels with stop losses down here at about 570. NXP, we've had this long-term trend line. In fact, you could probably move it up just a little bit, and you see earlier this week, this is why you want to have close eye on the technicals, as this stock reported earnings, gapped all the way down very close to the bottom of a channel line and found support there and immediately rebounded back. That's why I like to use the technical charts, because they help make these decisions for you. NXP reports earnings. There's all types of analysts and everybody kind of forming an opinion on it. But, well, you can just look at this chart and it basically makes the decision for you. Now, moving over to ARM Holdings, I'm going to go back to a daily view on this one. It's a little bit messy. I'll clean it up for us a little bit. This one did find footing at an area that we thought it would find footing. It's still in this channel, although you've just made a series of lower highs and lower lows. This one is painting two different pictures. The intermediate trend is still kind of intact, but just barely on this one. The fact that it just reported earnings probably gives me confidence, if you love ARM Holdings, that you jump into this one. But I showed you from a valuation perspective, a lot is actually already priced in to ARM Holdings. Now, SMCI is still a falling knife. These types of channel positions I do not buy. That's why I have a double red line on this one. We're not buying at the top of the channel. We're not buying at the bottom of the channel. This is a red knife or a falling knife. You're waiting for a breakout, a back test, and a higher high. We have not gotten that. We had a little bit of a fake out here back in October, but obviously the accounting scandals and fundamentals caused this one to gap down even further, although we should find some footing in the range that it's in between 22 and 32. But a lot of investors are going to be like myself, that have been around a long time and seen accounting frauds and things, seen these things go from bad to worse to basically bankrupt. A lot of investors like me will play hands off on this. Now, the meme crowd and the YouTube crowd and the pumpers and the dumpers, they'll be pumping this stock, and that's for up to you to decide. But until we get further clarity on this one's a falling knife, and I wouldn't touch it. Now, DELL looks absolutely sensational, continuing to walk up this trend line. You have to expect some of the business that has been pulled away from Supermicro. We showed it to you. The Q1 wasn't good. The Q2 guidance wasn't good. The company's blaming it on the Blackwell server. I don't think that's necessarily the case. I think that some of the demand and some of the supply is actually getting downshifted, and even some customers. Like, would you want to deal with Supermicro Computer, even if it's a slightly lower price, if the company is going to get delisted and potentially bankrupt and maybe the executives under fraud? Maybe you don't want to deal with them and you'd rather deal with DELL. Now, moving over to Micron, I'm going to do a MAGA money show here pretty soon. Micron is actually going to make that list. I'm probably going to be posting that to the main channel, but this is a stock that actually could benefit from a lot of things that the Trump administration wants to do as it relates to tax breaks for companies that manufacture stuff in the United States. It's actually interesting that Micron does a lot of manufacturing here in the United States. So if Trump is able to pass that type of tax regulation, well, a company like Micron could benefit. Now, Lam Research, obviously getting impacted by the China sanctions, is sitting at the middle of the channel. This can be an area where you can lightly buy. Got to be careful because people hear the word buy and you think that you got to unload your whole wad. No, if you wanted 10 shares of Lam Research or you want to add 10 shares to an existing position, this is a spot where you can add 1 or 2 continued pullbacks. You're slightly more aggressive on that. Applied Materials also in a very similar situation. You're in the middle of the channel. These middle of the channels can be light buying opportunities, but by all means, don't do a full allocation here because if the trend continues to move lower, well, you'll have a better buying opportunity coming very soon. Folks, that was Semiconductor Show for Sunday, November 10th. Props to all the veterans out there that are watching. We appreciate your service. We think about you every day, but certainly on weekends like this as well. Got a lot to talk about as we move into a new Trump administration when it relates to tariffs, tax policy, potentially dealing with China in a different way than the Biden administration did. We'll look forward to bringing that to you here on the channel. Until then, good luck with your investments.